Now, let's look at the general process that is involved in terms of developing models for short-term insurance contracts. In general, probably any kind of an insurance product that I'm looking at, there are a few important features that are associated with any kind of a product. Means there should be some kind of an insurable interest, right? Every product that is created, for every risk that is being addressed as a part of the product, that particular risk, corresponding to that particular risk, the policy holder should definitely have an insurable interest. Otherwise, it becomes as good as a gambling or a wagering kind of a contract. There should be some amount of a differentiation which clearly says that this particular policy holder has an insurable interest on that particular risk. He is looking more from a mitigation of the risk, not to make a gain out of that. So there should be some such kind of interest that can exist, and whatever the risk is, it is more of a financial in nature and nothing to do with the sentimental or any of those emotional kind of natures. It's a pure financial risk, and it has to be to a large extent quantifiable. So that is something which is very much associated with any product. So whatever the design that we are bringing in, it has to take these take these aspects into consideration. Apart from that, right, all the risk events that we are talking about, they have to meet some kind of important criterias. Whatever are the risk events, they have to be independent of each other. Means the risk one should not lead to risk two, and so on. They should be completely independent of each other. A simple way to put it is, when I'm taking the correlation between the various risk events, it should be very, very close to zero, very, very on the lower side. The probability of an occurrence of an event should be very, very less, which means a very highly certain to occur kind of an event. Generally, the insurance does not exist for that. And there should be a possibility for the pooling of risks of similar kind of risks. There should be large number of similar kind of risks that are going to occur, and a pooling of them should be comfortably occurring, which will reduce the uncertainty or the variance of the number. Certainty should be increased from that perspective. Whatever is the insurer, whatever is the liability that the insurer is taking towards the payment of the claims, there should be a limit on that, the maximum amount that the insurer can pay in respect of this particular claim. And to a large extent, there should be a mechanism to address the moral hazards. Probably they have to be eliminated to whatever extent possible. One reason being, it is more to do with the fraud. So the quantification becomes very much difficult, and it may so happen that people use it for their personal benefit. So the selection is happening against the insurer, which means there is a lot of unfair treatment. If it is not eliminated, probably more high risky people are treated on the same lines with the low risky policy holders, which means you are causing a disadvantage to one set of policy holders vis-a-vis the other set. So all these things should definitely be taken into the construction of any model. Apart from that, exclusive to the world of general insurance products, a few more things. If you look at majority of the general insurance products, the insurance is for a very short period, and that too generally for a fixed period, let's say of 1 year. right? And after that, the policy expires, and probably again there is a renegotiation. And in this case, it's not mandatory either for the insured or the insurer to go ahead with the contract, right? They can very well seize the contract and they can stop it there itself. So there is no mandatory obligation in terms of continuing. Very much similar to majority of the long term, very majority of the general insurance products. Apart from that, the claims, there is no fixed value that is set for the claims. So the loss is completely an estimated kind of a number itself. The loss has to be completely estimated, and probably that entire loss need to be proven before the settlement happens. It has to be confirmed from various sources that the loss has really occurred. The amount of that loss has to be estimated, then only the settlement will occur. And any claim does not necessarily mean that the policy is closed. In a life insurance, once a claim has been made, the policy is closed. But here, the claim does not mean that the policy is closed. Policy can still be in force. And claim can occur at any time, probably immediately after the taking of the policy also, any time. And once the claim has occurred, the policyholder has to report the claim as soon as possible. Right? The policyholder has to report the claim as soon as possible, but in some cases, there is some amount of a delay in terms of the reporting. Even in terms of settlement, though there is a possibility that the settlement for some of those claims can happen very quickly, some of them may take days, months, or even years to settle. So it's not straightforward. Sometimes lot many parties will be involved in terms of investigation. The settlement, which is the final liability of the insurer, can take too much of a time, because what is the amount that the insurer has to settle, it becomes very much not clearly visible, not clearly evident. So more and more detailed investigations have to happen regarding that. And especially when there are legal things that are involved, where the settlements have to come through courts, they may take a good amount of time, right? And so that determining the amount of loss is very difficult in some of them. So the time period that it takes for settlement could be a very, very big time period. And on the other side, once the claim, whatever is the time period, once the claim is initiated, till the day of settlement, whatever the costs that are incurred, they are to be settled by the insurer only. At least that part has to be clear. So, how much is the amount? There should be a proper estimate for this amount, so that appropriate reserving can be done, and that becomes one of the important activities as a part of any general insurance model that is getting designed. So we have to really understand again in these kind of claims, are they long tail claims or short tail claims? So I have to really understand from the claims perspective whether they are long tail or short tail. Those tails which take very long time to settle, they are called long tail claims, whereas those which are settling in a very short time, we are calling as short tail. Though I can't draw a clear cut distinction between anything that is below these many days is a short tail claim, anything above these many days is a long tail claim. So though I can't draw such kind of a line, probably on a broader scale, this happens to be the definition. There are wide varieties of products in the general insurance space, covering wide varieties of risks. So a detailed understanding of the different products and the risks is very much essential. Now, After understanding all these general insurance products to a great extent, now let's say I want to develop a kind of a basic model for a short-term insurance contract. Majority of the general insurance contracts are short-term. Even a few life insurance contracts are also short-term, especially when I am looking at a group or even the term life insurance policies. They are generally for a short term. In general, when you talk about the short term policies, the time period is fixed, right? More or less, generally it should be for a 1 year, or it could be much lesser also, right? It's a very short time period, and in this time period, the premiums are received by the insurer from the various policyholders, and the claim settlement happens in case some kind of loss occurs only during that particular time period. Anything that any loss that occurs after the time period, it does not get settled. Now, the choice whether to renew the policy or not is completely with the policyholder. Even in some cases, the policyholder, even if he wants to renew the policy, the insurer may not be interested in renewing. So either of both of them have to really agree on the renewal part. So both of them have an option whether they want to renew or not. Even if the renewal is happening, the premium may or may not be the same, right? All these things are there as a part of the general insurance model. And but whereas on the other side, when we are looking at the life insurance policies in general, which are long term kind of contracts, what we see is the premium is a level premium for the entire period. So though here the mortality rate, it generally increases with age. So logically speaking, the premiums also have to increase with age. But what we see is a concept of a level premium, which means the premium that is charged in the initial years is much, much more than what is needed for the expected loss, which means this excess premium is actually invested to earn some returns so that a reserve is built up to address for the losses in the later ages. If we see here, the premium should be this much at a later age, but even in that period, the premium is charged is only this much, which means to adjust for the premiums of the later period, the current period's premium excess need to be reinvested. It has to accumulate to a reserve which can be used in the later years when the premium on its own is not sufficient to meet the expected cost of the claims. So in general insurance, that need not be the case because majority of the products are short term. The premiums are renewed each year and there is no need for the same premium amount to exist in each of the years. And this can very well take into consideration the reinsurance also if at all something exists. So it can so happen that whatever the premium that has been received by the insurer, he may share a part of it with the reinsurer. So by sharing this part of it, this could be as per the agreement itself. And even in the losses that are raised during this period, a portion of the losses are being paid by the reinsurer to the insurer, again based on some kind of a formula that both the parties are typically agreeing upon. So the typical model that we are building should even take into consideration all these dimensions as well. So just to look out on a quicker note, any short-term insurance contract, if I am talking of, the risk can be with respect to a single policy or to a group of policies. and generally the time period is for 1 year or for a smaller period. Now this is where we'll talk about the basic model. We'll talk about a random variable S, which talks about the aggregate claims, whatever are paid by the insurer in that particular year, right? So we are always trying to look at creating the models for this aggregate claims. And the first step in this construction process is write S, break up this S into two parts. One, number of claims occurring in a particular year, and two, the amount of each of the individual claim. So basically it's like the number of claims multiply. So for each claim, so if I'm talking about x1 plus x2 plus so on xn, this is the first claim, this is the second claim, this is the nth claim. And I know that there are n claims that have occurred during this period. So my total claim amount, x1 is the first claim amount, second claim amount, nth claim amount. So probably in a notation way, I am writing it as S is nothing but xi, where I is from 1 to n. I am summing it up, right? So this is what we are calling it as an aggregate claim kind of a notation. And if you see that if n is 0, means no claims have come out, the sum of the claims is also coming out to be 0. And here I am very clearly looking out as n as a different variable. N could be random, even x could be random. So I am looking at two different things separately. Claim, the frequency of the claims, I am modeling it separately, and the amount of the claim, I am modeling it separately. Because even in reality, the factors that are affecting this could be different from the factors that are affecting this. See, if we just try to understand, let's say there is a bad weather, talking about a motor vehicle policy. If there is a bad weather, so probably a slippery roads, there is a good chance that the number of claims during that particular period will be very, very high. It may or may not impact the claim amount. But on the other side, let's say if there is a very high inflation in the country, it may or may not have any kind of a direct impact on the number of claims, but it will definitely have a very big impact on the claim amount, because the cost of the claims will go up because of the repairing costs, and all the costs are going up because of the inflation. The cost of claim is going to go up. So what we generally see is the factors that are impacting the number of claims could be very much different from the factors that are impacting the claim amount, which means it's very, very necessary for us to identify these two things separately and develop the model separately for each of them. And that's the reason the whole aggregate claim amount, we are looking at it as the sum of random number of quantities, random number of claim amounts. And this is where I'm having two different variables, one for the number and second one for the amount. These kind of distributions, we are calling them as compound distributions, right? So here two major distributions, one is for n, which is for the number of claims, generally a discrete distribution, and one for x, which is the amount of claim. Probably it can be any, but generally it could be some kind of a continuous distribution. So whenever I have a compound distribution which is partly discrete and partly continuous, we are calling it as a mixed kind of a distribution. And whatever the model that we are trying to build, right? Whatever the model that we are trying to build, we are interested in coming out with the moments as well as the distribution for this aggregated claims. And this entire thing will try to derive in terms of the moments and the distribution of n as well as the moments and distribution of x, and wherever the reinsurance related elements also need to be taken into consideration, even those elements need to be included as a part of the model, right? Now, whatever the model that we have brought out, S is sigma xi, where I is from 1 to n. Here comes lot of simplifications, right? When we use this model as S is sigma I equal to 1 to n xi, lot of simplifications we have brought in, right? Now, the first thing in as a part of this model is both for n as well as xi. We are making an assumption that the moments as well as distributions of both of them are known in advance, which is a big model assumption. In reality, probably I may have to estimate them from the data. Probably I may have to use the mechanisms like method of like a maximum likelihood, or method of moments, or method of percentile. Some such kind of a mechanism I have to use and try to estimate the parameters of the n as well as xx. So they are very rarely known with certainty. So I may have to estimate them, because theoretically I may not have an exactly fitting distribution for the claim amounts. They keep changing. So getting an exactly fitting distribution is very, very rare. And even if I am able to fit in an appropriate distribution, the parameter values keep changing with time. So even that has to be modified from time to time. And the portfolio will not be homogeneous at all. There may be different claim amounts for different sizes. So it's very rare that I get a proper distribution out. Then one more assumption that comes as a part of this model is the settlement of the claims. This model, simple model, is assuming that once the claim is raised, it settles quickly. But what we see is there is a huge time delay for some of the claims to be settled. So when the claims are settling quickly, the profit of the insurer is known very much certainly at the end of the year. But that even if there is a short delay, and in some cases the delay could be so prolonged, especially if a legal related route is there, which becomes very difficult, which means these things also need to be considered as a part of the model. But the model simply is trying to ignore those aspects when we are trying to build a simplified model. And this model does not consider the expenses. It only talks about whatever the premium that they are receiving. The premium is received as an adjustment to the claims or a compensation of the claims plus some amount of profit. But the real world model should even try to model the expenses, right? And only then the real profitability model can be looked at. And one of the other important things is the interest rates. This model has completely ignored the concept of the interest rates, which are the most important thing, especially in the long-term insurance contract, because as we have discussed earlier, the excess premium needs to be invested to really pull up the reserves, which can be used as an adjustment for the cost of claims in the later periods. So the model should really take these things into consideration. And as a part of the model building process, Even lot of other elements need to be considered. The previous claims record of the person, even that goes as a one of the parameters for, or one of the inputs for deciding the claim settlement process, for determining the premium to be charged. So while building a model, though a simplified model can be good enough, but if it ignores all these various things, probably the model may not be fit for use, right? So when we are building a simplified model, all these things will have to go into the back of our mind. And some of the major things that we have to run through, all the claim amounts, they are independent. While designing, we will have to make sure that all the claim amounts are independent. Now this is where probably for a catastrophic kind of claims, the independence will not exist, because the all these can occur only in one single in case of one single catastrophe. So when we are bringing in the catastrophic claims into picture, this rule may not be applicable, but for general things, these are assumed as independent as well as the identically distributed kind. And even the random variable n, which is the number of claims, is independent of each individual claim. So individual claims are nothing to do with the number of claims. Our number of claims are not affected by the amount of individual claim. And amount of individual claim of one single policy is not affected by the amount of individual claim of other policy. And the distribution of these amounts, it is more or less uniform across time. And a few more assumptions that go as a part of the model. All the claims are non-negative only. We are not talking of negative claims where the policyholder will where the policyholder has to pay a claim amount to the insurer. We are not looking at those kind of claims, which means the probability that xi is less than or equal to x is equal to 0 for x less than 0. For which means the probability that xi is less than or equal to 0 is directly 0, or less than 0 is 0 only, right? And the majority of the formulas that we are going to derive for building the model, they are based on the moment generating functions. For the aggregate claims, moment generating functions for the number of claims, and moment generating function for each individual claim. And we also make a few more terminologies when we are building a robust model. G of x, we call it as the cumulative distribution of S, means G of x comes out as probability that S is less than or equal to x, and f of x we generally denote it for xi, probability that xi is less than or equal to x. So and even for the moments, we generally denote it for mk. Kth moment is generally denoted as mk. So using all these various inputs, now we have to get in terms of building a model. So whatever we have discussed till now is preparing ourselves to get towards building of a short-term insurance-based model. What are the various terminologies that are involved? What are the various things that need to be considered? All these things, a basic idea of them will help us in terms of going further in terms of building a collective risk model overall. All right.